Albertsons recently announced earnings for their first quarter of fiscal year 2023. Their stock is down 18% over the last year, while the rest of the market is up 7% over the last year. So they're completely underperforming the market over the 12-year chart. And so in this video, as usual, I'm going to look at some of the recent news that came out surrounding Albertsons. I'm going to look into their financial statements, and I'm going to use a discounted cash flow model and figure out Albertsons' weighted average cost of capital so that we could figure out what their intrinsic value per share is to know what a good price would be to buy into Albertsons from a value investing perspective. So for starters, we can see right here, there's an article titled Albertsons Companies Are Resilient and Promising Investment in the Retail Sector. We can see right here in the first paragraph that it points out that Albertsons is a leading operator of food and drug stores in the United States, and it's been making waves in the stock market recently. On Friday, the company's stock opened at $21 per share, showing resilience in uncertain times, and investors are closely monitoring Albertsons' progress, especially considering the fact that their stock price is fluctuating quite wildly, down to a $19 per share low and a $30 per share high in the last 52 weeks. Right now, Albertsons has a debt-to-equity ratio of 3.91 and a quick ratio of 0.18 and then a current ratio of 0.78, which mitigates concerns regarding liquidity. They have a very small market capitalization of only $12.31 billion, so they remain a very enticing prospect for investors who are seeking opportunities in the retail sector. Their PE ratio at the moment is around 10 times earnings, which is pretty attractive considering their earnings performance. And on top of that, their price earnings to growth ratio of 1.62 suggests favorable expectations for future growth prospects for Albertsons. Lastly, we can see right here that the company has demonstrated stability with a beta value of 0.58, which shows that they are less volatile than the rest of the market comparatively. Now I want to look at their financial statements, and we can see right here, this is their balance sheet. Total assets are down from $26 billion to $25.8 billion from the prior period. And then we can see that most of their business is financed by liabilities. They only have $2 billion of stockholders' equity, which means that they have about $23 billion of total liabilities. And of their stockholders' equity, we can see that their retained earnings has increased from an accumulated deficit of $185 million to retained earnings of $159 million from the prior period. So they do have a lot more cash to redistribute back to shareholders if they want to. Next, we can see their income statement, and we can see that their revenue has increased from $23.3 billion to $24 billion year over year for their first quarter. So that's an increase of 3.4%. And then we can see for bottom line net income, that's decreased unfortunately from $484 million to $417 million. So it's down 13.8% year over year. Lastly, we can see their cash flow statement. So far, cash flow is down from $990 million to $838 million for the first quarter of their fiscal year 2023. And we can also see that they've paid dividends on common stock amounting to around $69 million, which is right about on par with the $63 million in dividends that they paid out to shareholders in the last fiscal year 2022 first quarter. So they're still prioritizing returning value back to shareholders, but they probably could return a little bit more value, especially considering that their operating cash flow is sitting at nearly $1 billion. So they're probably opting to invest that capital back into the company as opposed to distributing it to shareholders. Now I want to use this discounted cash flow model to figure out the intrinsic value per share for Albertsons. We can see that for the model, I am using a growth rate of 7.32%. And I got that growth rate from the historical growth rate calculation model right here. We can see that in 2018, Albertsons had free cash flow of $1.01 billion, and their free cash flow in 2022 was $1.34 billion. So that's growth over the last 4 years, showing a historical growth rate compounded annually of 7.32%. So that's where I got the growth rate for the discounted cash flow model. And then in order to figure out the discount rate for the model, I need to figure out the weighted average cost of Albertsons capital. And I figured that out by using the weighted average cost of capital calculation right here. We can see that for Albertsons' balance sheet, the book value of their equity comes out to be around $1.6 billion, whereas with their debt, it's around 24.5 billion. For their most recent full year, their interest rate on their debt was 4.54%. Their effective tax rate was 21.8%, and the 10-year treasury yield, or otherwise known as the risk-free return right now, is 4.04%. As the article pointed out, Albertsons is less volatile than the rest of the market. They have a beta of 0.38. Average stock market return is 10% per year. And so we're able to figure out the cost of their equity similar to their cost of debt. We take the risk-free return, add that to Albertsons beta, and then multiply that by the stock market return on average, and then subtract the risk-free return from that. That gives us their cost of equity, which is 6.3%. We can see that the equity proportion makes up a very small percentage of their balance sheet, only 6%, whereas their debt proportion makes up 93% of their balance sheet. So in order to figure out their weighted average cost of capital, I multiplied their equity proportion by the cost of equity, added that to the debt proportion multiplied by the cost of debt, and then I multiplied the debt proportion by the tax yield, which is 1 minus the tax rate of 21.8%. That gave us the weighted average cost of all of Albertsons capital, which comes out to 3.72%. So we can see I plugged that into the discounted cash flow model here. Terminal value 10, their free cash flow for the most recent full year, which was 2022, was 1.34 billion. So far, they have a net debt position sitting on their balance sheet of 8.45 billion, and they have about 575 million shares outstanding. That puts their estimated intrinsic value per share at $35 per share, which means that at the current share price, they are definitely trading below intrinsic value per share. They're actually trading between a 30 to 50% margin of safety at the moment. I also did a competitor analysis comparing Albertsons to some of the other companies in their industry. We can see I'm comparing them to Kroger and Walmart. Across the board, Albertsons has the highest gross profit margin, highest net profit margin, and the highest return on assets in comparison to their two competitors here. They also have the lowest price to earnings ratio, and they also have the highest dividend yield. So in terms of comparing them to their competitors, Albertsons is flat out dominating across the board, the highest profit margins while also trading at the cheapest price relative to their earnings and also paying out the highest dividends. So without a doubt, the number one spot for this competitor analysis would go to Albertsons. And lastly, to end off the video, I wanted to compare Albertsons to some of the other companies we've looked at in our past videos. I'm going to be comparing Albertsons to the other companies based on share price compared to intrinsic value, growth rate, gross profit margin, net profit margin, dividend yield, second quarter year-over-year revenue growth, second quarter year-over-year earnings growth, and then also stock performance over the last 5 years. For starters, we can see that for the share price compared to intrinsic value, Albertsons comes in second place because they're currently trading at 0.61 times their estimated intrinsic value per share. So far, it's just Google, Albertsons, Alibaba, and Etsy so far that we've seen that are trading below intrinsic value per share. Next, we can see for their growth rate, Albertsons had a projected growth rate of around 7%. So that is not good enough to get them onto the growth rate table historically for all the companies we've looked at in past videos. Kura Sushi holds the highest at 37%. For gross profitability, we saw Albertsons had a gross profit margin of around 20 to 30%. Definitely not nearly good enough to get them onto this table. Adobe holds the number one spot at 86%. For net profit margin, we can see that Albertsons had a net profit margin of only in single digits, around 1 to 2%. Definitely not good enough to get them onto the net profit margin table. So far, Occidental Petroleum has the number one spot with a 36% net profit margin. In terms of dividend yield, we can see that Albertsons did make it onto the table, and they are in fact very competitive with a 2.34% dividend yield. So basically for every $100 you invest into Albertsons, you're getting paid $2.34 in dividends per year. 3M holds the number one spot at nearly $5 for every $100 you invest into 3M. We can see that for second quarter year-over-year revenue growth, Albertsons only had year-over-year revenue growth of 3.4%, which isn't good enough to get them onto this table. Tesla has the number one spot at 47%. For second quarter year-over-year earnings growth, Albertsons earnings actually decreased 13.8%, so it's not good enough to get them onto the earnings growth table. Kura Sushi holds the number one spot for 240% year-over-year earnings growth for the second quarter. And lastly, we can see for stock performance over the last 5 years, Albertsons does not make it onto the table. They're only returning around 40% over the last 5 years, which isn't good enough to get them onto this table. Tesla holds the number one spot with a 1,144% return over the last 5 years. So to sum up, basically Albertsons is not very competitive on any of the tables that we have for the past companies we've looked at. They're really only competitive on the dividend yield table and then also on the share price to intrinsic value table. We saw from the discounted cash flow model that Albertsons is currently trading at 61% of their estimated intrinsic value per share, which is very competitive compared to all of the other companies we've looked at. And we also saw that from the competitor analysis that Albertsons is completely dominating their competition, specifically Kroger and Walmart, with higher profit margins, a better price for their stock price, and then also a higher dividend yield. So let me know in the comment section down below what you guys think of Albertsons. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.